Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. I'm the Director of Education here at the ISE, and you can always contact me at asktheexpert@ise.com or at the Ask site of fxoptions.com. Nicole Wachs is the Options Analyst and Director of Education at TradeKing, and really I'm so pleased that we have Nicole with us today because she's a former market maker. She's spent a lot of time trading Condors and Butterflies. That's today's topic. And the title will be Condors Butterflies, is there an ideal strategy for FX options? So without further ado, I want to introduce Nicole Wachs. Nicole.
Great. Thank you, Steve. And I have control here. I just want to make sure that the slides are changing. I believe so. So thanks for having me.
You're welcome. Thanks for coming.
It's going to be a great session. Thanks for everyone who's joining us. Before we begin, I just need to cover some compliance matters. The examples that follow do not take into consideration taxes or margin requirements, which may significantly affect the consequences of a given strategy. So please review the costs involved before trading. Options involve risk and are not suitable for all investors. Please read a copy of the characteristics and risks of standardized options, available at tradeking.com/ODD. Multiple leg option strategies involve additional risks and multiple commissions and may result in complex tax treatments. Please consult a tax advisor before trading. Any strategies discussed and examples used are for illustrative and educational purposes only and are not to be construed as a type of endorsement. System response and access times may vary due to market conditions and other factors. Past performance is not a guarantee of future results. All investments involve risk. Losses may exceed principal invested, and past performance is not an indicator of future results or returns. The projections or other information generated by TradeKing's tools are hypothetical in nature and do not reflect actual investment results and are not guarantees of future results. And finally, webinars are provided for educational and informational purposes only. TradeKing provides self-directed investors with discount brokerage services and does not make recommendations or offer any type of advice. Before I get into today's topic, I just wanted to give you a few announcements about TradeKing. We're a great place to trade. We have great commission structure, $4.95 a trade plus 65 cents per options contract. We have been recognized for being one of the great option-friendly brokerages and best for option traders regarding the suite of free tools that we provide. We also have a great trader network where you can connect with other traders, learn from them, mentor them, see what they're trading, and so on. You can check that out at community.tradeking.com. And we're also involved in the various venues of social media, Twitter, Facebook, YouTube, and LinkedIn. So please check us out at those venues. And finally, as Steve mentioned, TradeKing has our very own webinar series. It conflicts with ISE's webinars, but we also record every session. If you're interested in joining a live event, they occur on Tuesdays at 5 p.m., so you can go straight over there after we finish here at 5:30, and that will begin. It will have already started, but will continue until about 6 p.m., and that website is webinars.tradeking.com. And if you're not aware already, the ISE has several different currency pairs that you can trade options. And tonight I'm going to discuss briefly about EUI, the euro, US dollar based, and we're going to get into an example of a condor for that symbol. All right, so as Steve mentioned, this is a two-part series. Tonight I am covering condors, and then December 14th, I will go into the butterfly strategy. And the point here is that I'm going to lay out what are the basics and the things you really need to know for each strategy, not from a purely theoretical point of view, but from a practical sense. You know, what do you need to actually do these trades successfully? And then also contrast them in part 2 so you can see where one applies and where one may not apply. Because obviously these are 2 different strategies and they have different characteristics, and you need to know what you're dealing with so that you can apply them effectively. So please join me for part 2 at 4:30 on December 14th. All right, so now that we're here, let's get into what really is a condor. And for those of you who have never traded one before, or you're just getting started, it involves 4 different options. And therefore, there are 4 different strike prices going at the same time. 2 of these options you're going to buy. I'm noting that as long. And 2 of these options you're going to sell. And I'm showing that here as short. Okay? And altogether, these 4 options create 2 different spreads. And they're focused around the at-the-money strike. Well, what does that really mean, the at-the-money strike? It means that you are creating these spreads around where the underlying, the index, the stock, the currency, whatever it is you're trading, they're focused around where that current price is today. So you're using out-of-the-money or in-the-money options, depending on what type of condor is involved. And generally speaking, you are putting this trade on not more than 2 months from today. So you're going to either use the front month option or the second month option in the series. Something to keep in mind, though, for the variety that we're talking about, all the options have the same expiration month. So if you're trading a condor in December, all 4 options are for December. If you're trading a condor for February, all 4 options are in February. And the ratio of these options is 1-to-1. So all 4 strike prices, all 4 strikes have the same number of contracts traded. There are other variations, but that is what we're just focusing on, the basic setup today. There are 3 different condors. There's one using all calls, and that's the call condor, right? There's one using all puts, and that is a put condor. But what we're going to do today is cover the iron condor, because that tends to be the most popular one amongst retail traders. Whenever you hear the term iron, that just means that calls and puts are being used together. Same is true for the iron butterfly setup. Just keep in mind, because there are 4 different strikes going at the same time, these are referred to as legs. So there are other considerations to be aware of, such as assignment and expiration risk. And obviously, there are more commissions involved when you have more strikes that you're trading. So please be aware of that before you get in. And also note that some of these may be ill-affected by taxes, so check with your advisor before trading.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.